You've probably heard the news, right? Japan is back. After decades of being stuck in the mud, the Japanese stock market is absolutely on fire. And in 2024, something huge finally happened.
That's right, the Nikkei 225, Japan's most famous stock index, finally, after 34 long years, smashed its old record from the bubble era, blowing past 40,000 yen. The champagne is flowing, investors are euphoric, and everyone's saying the lost decades are finally over. But hold on a second. Before you rush out and pour your money into a Nikkei ETF, there's a pretty big secret you need to know.
You see, when you buy the Nikkei 225, you might not be buying what you think you're buying. You're actually buying a very specific, and let's be honest, a kind of strange slice of the market that has this weird obsession with fleece jackets. Okay, let me explain.
And that brings us to what I call the Uniqlo problem. To really get it, we have to look at how the Nikkei is actually built because it's special.
So, in the US, we're all used to the S&P 500, which is market cap weighted. That means massive companies like Apple or Microsoft have a massive impact. Makes sense, right? Bigger company, bigger influence. Well, the Nikkei is a price-weighted index. This means it's the company's share price that matters, not how big the company actually is. And this one little difference leads to some truly bizarre outcomes.
And this is where it gets just wild. I mean, look at this. Toyota is the undisputed king of Japanese industry, a global titan. But in the Nikkei 225, its weight is less than 1%. Meanwhile, Fast Retailing, the company that owns the clothing brand Uniqlo, makes up over 11% of the entire index. It's insane.
Yep, you heard that right. A single clothing store has more than 10 times the power over Japan's headline index than the world's biggest automaker. So if Uniqlo has a bad quarter, the Nikkei gets dragged down, even if Toyota is selling cars like hotcakes. The key takeaway here is the Nikkei isn't really an index of the Japanese economy at all.
Okay, so if the Nikkei isn't the whole economy, then what on earth is it? Well, the answer might surprise you. It's basically a high-tech growth fund wearing a trench coat. You could almost call it a Shadow Nasdaq.
And this chart just says it all. Over half, 51%, of the entire Nikkei 225 is just tech stocks. Then you add in consumer services, and suddenly you're looking at nearly 75% of the index tied up in just two areas. What about the banks, the utilities, all the boring but essential companies that actually make Japan run? They're just background noise. They barely move the needle.
So when you invest in the Nikkei, you are not making a broad bet on Japan Inc. No, you're making a highly concentrated bet on Japanese tech and growth stocks. When global AI stocks are hot, the Nikkei soars. It's like you're riding a Ferrari, but half the car is missing.
All right, so if the Nikkei is the flashy race car, what if you actually want to invest in the entire Japanese economy? Well, it's time to meet the real boss, the TOPIX index. You see, while the Nikkei is this little exclusive club of 225 companies, the TOPIX is the whole stadium. It tracks over 2,100 companies. We're talking almost 95% of the market. It's the whole shebang, the big players, the little innovators, all of it. Honestly, here's the absolute best way to think about it. The Nikkei 225 is a sharp sword. It's aggressive, it's laser-focused on high-tech growth, and yeah, it can deliver some spectacular wins. The TOPIX, on the other hand, is a heavy shield. It's defensive, it's super diversified, and it protects you with the full strength of the entire nation's economy. And here's the real kicker. Just look at who uses which index. The Nikkei is what you hear about on the nightly news. But the pros, the really big money, I'm talking about the GPIF, the world's largest pension fund. They don't mess around with the Nikkei for their core strategy. Nope, they use the TOPIX. And why is that? Because it's scientific, it's diversified, and it's a true reflection of the market.
So this all brings us to the big question, doesn't it? Now that you know the difference, how do you choose? Well, there's actually a pretty cool little tool that can help you get a feel for the market's temperature. It's called the NT ratio. It's super simple. You just divide the Nikkei's number by the TOPIX number. When this ratio starts to get really high, it means the Nikkei's flashy tech stocks are starting to drift pretty far away from the reality of the broader economy. It's kind of a warning sign that the market might be getting a little speculative, a little overheated.
Ultimately, the choice is yours. Do you want to bet on that elite club of 225 companies and ride the high-tech Uniqlo-powered roller coaster? Or would you rather own a piece of the entire Japanese ecosystem, with all of its diversified strength? There's no right or wrong answer here, but now you can make a truly informed one.
So before you jump into all the hype around Japan's comeback, just remember to look under the hood and decide which version of Japan you actually want to own. And please, whatever you do, don't let a fleece jacket dictate your entire portfolio. Happy investing!